After a quiet couple of years on the Australian deals front, it's been anything but a slow start to 2025. Is this a sign of things to come? Hello, I'm Rebecca Jones and welcome to the Bloomberg Australia podcast. For the top brass at one of Australia's biggest wealth managers, Insignia Financial, the summer holidays have been cut short by a flurry of takeover offers from two big overseas players, Bain Capital and CC Capital Partners. This week I'm joined by finance reporter Harry Brumpton, who's based in our Sydney newsroom, to tell me who these firms are, what's behind all this action and what it could all mean for big acquisitions in Australia in the road ahead. Harry, welcome to the podcast.
Thanks for having me, Beck.
Who is Insignia Financial and why are potential buyers circling? Can you give me a bit of the backstory here?
Yeah, so until 2021, Insignia was actually known as IOOF, which may be a familiar name to many people in Australia. That actually stands for the Independent Order of Odd Fellows, if you can believe it, which is one of those kind of fraternal societies dating back to the 1800s that at one point was larger than the Freemasons. So they kind of, these orders, they had these, it kind of functioned as a mutual savings entity in the years before insurance and before reserve banks existed as a backstop. Through the years, it's obviously grown and developed and, that fraternal order, splintered all across the world. And IOOF in Australia here was one of the big beneficiaries more recently and grew really quickly as a lot of the big four domestic banks in Australia felt a lot of pressure from shareholders and regulators to get out of this wealth management business. And so IOOF was snapped up all these advice businesses, including the arm from ANZ and also the MLC business from NAB. So pretty big. And despite that size, though, and the colourful history, what they're kind of facing now is the fact that they're actually losing money out the door because people are switching to other products. They had outflows of $1 billion in the 3 months up to September 30 last year. And then on top of that, there's a whole layer where their costs are going up as well because compliance is getting more costly and technology, is getting more expensive and we need new back-end systems. All of that kind of calls for a restructuring, which when you're carrying a fair bit of debt like Insignia is, those problems only become more pronounced. So we're in a situation now where Insignia CEO, Scott Hartley, is pretty new to the job. He's been in since March last year. And if the name's familiar, it's because he was the CEO of AMP and before that ran Sun Super, which is another big pension fund here in Australia. He's been out pitching a 5-year strategy, which is basically a turnaround plan. And we interviewed him back in November and he talked to us about targeting more affluent customers and kind of developing plans to streamline operating costs across the business as well. But at root, you've got this shrinking funds base, which means shrinking revenue, higher costs, and on top of that, a pretty substantial stack of debt. So it all puts them in this kind of tight spot. And the share price as a result of that is more than halved since 2020.
Right. And potentially watching Bloomberg television or reading our stories has been Bain and CC Capital. Can you tell me a little bit about those two outfits?
Bain Capital is, one of the original vanguard firms that built the private equity industry. It was actually created by Mitt Romney, the senator and former presidential candidate. When he was, and if the name Bain is familiar, that's because he was a consultant at Bain Consulting. Back in the 80s, they were advising all these companies how to fix themselves up and do better and increase revenue. And then he thought, why don't we raise a bunch of money and we'll buy these companies ourselves and turn them around ourselves? And that was how the private equity industry was born. So Bain goes back, now it's very separate from Bain Consulting, but Bain Capital goes back to the early days of private equity decades ago. And as for CC Capital, that's kind of a bit of an eponym for Chin Chu, who's a US billionaire of Vietnamese descent and an alumni of Blackstone, who are the world's biggest private equity firm, and he ran the private equity arm of Blackstone, and he kind of specialised in insurance takeovers and has a long track record. He struck out on his own since 2015 and built CC Capital, and he's done a ton of deals with them, especially around the finance space, and he's building this kind of blueprint where you're buying insurance companies and using the cash on float from the insurance companies to build an even bigger capital base to go buy more companies. And so, we've got this guy with a pedigree from one of the biggest private equity firms, and then one of the largest original private equity firms as well.
And both Bain and CC have made unsolicited approaches to Insignia to acquire them. How close are we to a deal at this point? I mean, there's been a lot of bids and counter bids flying around. It's hard to keep track.
It is. All of it came out of nowhere as well in December, and typically in Australia, not a lot happens before Australia Day in financial markets. And then CC Capital, put a completely unsolicited counter proposal in early January as well. So these guys just kind of bid and counter bid without the company really having to do much at all, actually. And the board didn't really have to say anything apart from, we're aware of these offers, we'll have a look at them. And before you knew it, that they bid each other up to a premium over the share price of 60% to where it had been trading on the 3 months before all these offers came in. It's got to the point where the boards felt it's incumbent. These offers are pretty solid, so that they've had to it's as part of their fiduciary duty to shareholders have allowed both sides, drawn up standstill agreements with them, and have allowed both sides access to a level of due diligence, kind of open their books up so that both sides can potentially increase their offers down the track. And we'll see who prevails out of this between the two of them.
So we've got two firms from the US making bids for an Australian company at a really unfortunate time for the Australian business cycle, when most of us are all out of town lying on a beach if we're lucky enough. Harry, what is it about our system that makes it so appealing to these big overseas players? Why are they keen on Australian businesses?
Yeah, I think one of the big elements is that is our superannuation industry is a defined contribution system where under law and legislation we are just chipping in continually, rising up to 12% in June this year of our annual salary. So if you think about that as a business model, that's just 12% guaranteed growth a year. Which, how many industries do you find that in? As I said, when I was talking about Insignia, there's pressures on Insignia, but and across the whole market, there is a countervailing kind of melting ice cube phenomenon. There's competition from ETFs or exchange traded funds, as well as industry super funds, which are super fee focused. So over the last couple of decades, net investment inflows into ETFs managed by some of the big offshore names, say like Vanguard or State Street or BlackRock, which a lot of people use, that's grown 36-fold. Whereas, in comparison, over the same, couple of decade time, 22-year time frame, yearly net inflows into, the more actively managed funds rose from it was about 30 billion a year in 2001. And now it's actually, there's redemptions, and they're seeing outflows of about 37 billion. So you can see where, you've got this growth tailwind, but if you can turn around some of those other industry trends, you might be able to do a classic private equity play of, build something, fix its problems, and then make it worth a lot more down the track.
I want to talk now about what's next in the battle to buy Insignia. Insignia being a relatively new name for a pretty old Aussie company that's facing some not insignificant challenges. As you've said, Harry, both Bain and CC Capital now have access to their books. Is the next step here for both of these outfits to try and really convince the board and the shareholders that they're the better option to improve things, or is this just going to come down to what each are willing to pay? What's the share price telling us?
It's a sticky wicket. It's going to be a hard one for them to untangle. I think if you're a shareholder in Insignia, you've got to be pretty happy, and it does, that there is a lot of pressure to get a deal done, or at least a lot of interest by other funds in this business. So I wouldn't put a number on it, but that there is a high likelihood of a deal here, and that's the way that the shares have reacted. Adding fuel to the fire, though, for these private equity firms is, I spoke with one of the top banking lawyers and finance lawyers at Herbert Smith Freehills, Michael Vrasakis, and he kind of called it acquisition musical chair syndrome, where these private equity players or potential acquirers can see that there's a business proposition there, and that they realize there's a shrinking number of kind of accessible targets, and that drives up bidding activity because you want a seat at the table. You want to have a platform that you can build off and consolidate off, and there's only so many of those going around.
And on that note, after the break, we'll ask, are more mergers and acquisitions coming to Australia in 2025?
Okay, not surprisingly, our stock of the day today is Insignia Financial, a $2.9 billion bid, seemingly out of the blue from CC Capital Partners based in the US.
Shares in wealth manager Insignia Financial have soared to their highest level in more than 3 years.
Clearly, we're seeing this sort of boost to overseas players showing some appetite to money management firms in Australia. There's a lot of exposure, of course, to one of the world's biggest and fastest growing pools of pensions.
Welcome back to the Bloomberg Australia podcast. I'm Rebecca Jones. Today I'm speaking with our finance reporter, Harry Brumpton. He's based in our Sydney newsroom. Harry, so you told me a little bit about the bidders, these foreign private equity firms. They're cashed up, they're on the hunt for the next big investment. I've got to ask you a very obvious question now. Why do they have so much money, and are they likely to want to spend more of it in Australia?
Yeah, I think it's probably likely that they are. I've been looking at and writing about for a while this armada, as I call it, of foreign capital coming to Australia. Globally, the private equity industry has returned about 10 to 13%, maybe differing estimates according to different sources over the last 2 decades. Like that's per year. So if you've been an investor in the private equity industry, you're more than willing to kind of keep giving your money to them and keep allocating money. And as a result, their success is compounded. And private equity firms have $2 trillion to allocate out there in the world at large now. Those are funds that they've raised that they haven't yet allocated, or what's called dry powder in the industry. What's more, that money is unleveraged. So just like when you buy a home as an investment, maybe you put down 10 to 20%. Private equity firms do much the same thing. So if they've got $2 trillion, you're looking at a much bigger check size in reality for things that they could buy. Let's do some simple back of the envelope arithmetic. The Australian Securities Exchange cumulative market cap is about 1.6 trillion. So, even if we only get a fraction of the world's flows, it's a pretty big amount of deal making to come down the pipe.
1.6 and $2 trillion. Wow, that's obviously all in US dollars, so even more in Aussie. We know that these PE firms are keen for a slice of Australia's pension pie. Listed companies give them one way of doing that, although, as you say, it really isn't as simple as having a truckload of cash, as competition is rife and these targets can come with a bit of baggage. Harry, finally, beyond this deal, the one that's brought the bankers home from the beach early and back into their offices, what are the prospects for other M&A in Australia this year? What else should we be keeping our eyes on?
There's, I think it's a pretty positive outlook for M&A here in Australia. Although I will caveat that by saying that having talked to a lot of experts in the field, that M&A bankers and lawyers are in a permanent state of outward optimism. You may as well kind of ask your real estate agent what the market's like, and they're always going to say it's a great time to transact. As Charlie Munger once said, you don't ask your barber if you need a haircut. But the fact is that there are a few things kind of pointing to positive trends in deal making. The first is that the Aussie dollar is substantially lower than it has been, and that makes local assets pretty cheap. The RBA has been, the Reserve Bank here has been pretty dovish and been very slow to raise rates to the level, some levels that we've seen elsewhere in the world, and in fact forecast to cut rates this year as well, in line. So we never quite got super restrictive policy, and that'll make things a lot cheaper on a relative basis as well. And then our regulators and competition watchdogs have been a lot more aggressive, and that might sound like a not a great point, but the fact is that some of that legislation doesn't actually take effect until later this year. So if there's deals that are kind of close to the line or have been mulled for quite some time, you could actually argue that there's a bit of an impetus to push that forward and get things completed before the new rules take force, and start potentially slowing deals down a bit later or into next year. I'd say that cross-border capital investment through M&A has been really strong over the last couple of years, just generally, with a lot of interest from North America and Western Europe, and big deals from our trading partners over in Japan as well, who really like Australia's shores as a place to reinvest their capital. Overall, yeah, pretty positive, I'd say, Beck. Harry,
thank you for joining me, and thank you for listening to the Bloomberg Australia podcast. I'm Rebecca Jones. This episode was recorded on the lands of the Wurundjeri and Gadigal people of the Kulin and Eora Nation. It was produced by Paul Allen and edited by Amy Bainbridge, Adam Haig and Ainsley Thompson. Don't forget to follow and review the show wherever you get your podcasts, and sign up for Bloomberg's free daily newsletter, Australia Briefing. Go to bloomberg.com to subscribe.